Welcome back to Market Minutes, everybody. We are filming the last episode for 2025. I'm pleased to be joined today by Josh Robbins, who is our Associate Vice President at Peakhill Equity Partners. Peakhill Equity Partners is a platform focused on co-GP development and preferred equity deals, primarily in the United States and in Canada. Josh, thank you for joining me today.
It's my pleasure. Thank you for having me. Hi.
So this year has been kind of tumultuous, I think, for Canadian investors who typically would look for U.S. opportunities. The Trump administration, tariffs, has really caused an uproar. How are we seeing those influences in our selection of opportunities that we're pursuing?
I mean, it's an interesting time for sure, especially being up here in Canada, looking at the U.S. market. And I think as the year started off with Trump taking office, there was a lot of people that questioned our approach and questioned why we're still focused on the U.S. given so much uncertainty. And with the tariffs kind of taking up a lot of the oxygen and kind of across the industry. But I think what was interesting is as the year evolved, the noise was a lot more than the actual impact. When you look at a construction project and you actually go in and look at the materials, it's really only it's about 8 to 10% of materials that are imported from outside the United States. So that impact, when you break it down like on a line by line item over a whole construction budget, is extremely minimal. So from a tariff perspective, the impact financially was minimal. But when you look at it from a Canadian investor and kind of their sense of national pride and all that, putting money in the United States, that piece of it was a little bit more challenging. But I think as the year went on, I think kind of some of that sentiment started to pull back.
So we're focused on the United States. It's a bigger market. We see the co-GP strategy, which is what we're really focused on, isn't quite as developed as it is in the United States, or not developed at all here in Canada. So those are some of the factors as to what's really driving our focus in the United States. Now, this past year, we've closed on 2 transactions, both in California, which is, as contrarian as a Canadian will look at the United States, is like, do I want to invest in the U.S.? Many people would be even more contrarian about why do I want to invest in California, which has historically been, hard state development. So what's the focus? Is the focus the United States? Is the focus California? Is there a strategy here?
No, for sure. I think it's a good question because, like you said, the contrarian look to it. I would say first, when you look at California as a whole, California has the 4th highest if it was a country, it has the 4th highest GDP in the world. So to basically X off an economy of that size, to us, makes no sense. Like you touched on with kind of its democratic state, and that brings its own challenges with rent control and issues like that, which has kind of led us to invest in specific markets, not LA, in downtown LA, but Thousand Oaks, and not in downtown San Diego, but a high growth submarket like La Jolla or the University Talent Center area. Those are the kind of opportunities that we like to find.
As a macro, it's not that we love California, it's that we understand the submarkets. We understand what's driving the local economy, what's driving the local population, and that's kind of how we make our decision around investing. So that being said, we've focused almost exclusively, on the multifamily side. There's been a big push in other asset classes, specifically seniors housing with an aging population, data centers as we shift more and more towards, AI. Why are we not looking into those asset classes? Why just multifamily?
It's a good question, and I think we know rental housing, but data centers have become kind of top of mind for a lot of investors. There's a lot going on in that space. And we've looked at some opportunities. I don't think we've, underwritten them much further than kind of initial high-level review, but it would be foolish to not look at them and try to understand it. But we know rental housing. We know multifamily. Our team, our relationships in the U.S. are based in multifamily, in rental housing. And I think for us to grow and as our platform develops over the next 5 years, for us, we're best suited to stay where we have our relationships and stay where we know best. And I think we'll be able to deliver the best returns to our investors when we stick in the rental housing space, whether that's multifamily rental, development, acquisition, BTR, single family rentals, or potentially even student housing.
So that actually segues perfectly. Obviously, we want to grow the platform. We've done a couple of deals, as we mentioned, in California in 2025. What's on the horizon? If you look in your crystal ball, so to speak, what's your outlook for 2026 in terms of, the co-GP preferred equity platform that Peakhill is operating?
Yeah, I mean, I think it's an exciting one. I think we've kind of touched on bits of what I think will move us into next year, and I think key to me is our relationships with these developers and targeting the right markets for 2026 specifically. I think for us, we want to target some of these still unique pockets like 1,000 Oaks or La Jolla, a high growth submarket with growing populations and good employment, and target, specific development partners that understand those markets, understand development today at a time when there is a lot of uncertainty.
All right, so 2026, we're going to do some more deals with some good partners and some it's exciting times ahead.
We're excited about it.
That's great. I'm looking forward to it as well.
Thank you.
Thank you, Josh.